I think it is such a great opportunity that Baron has asked this question because the thing is market structure for me is kind of like it encapsulates context as a whole and it tells me exactly what the highest probability the direction of price is right now. So let me break that down for you guys. And you guys learned this in week 2 content of this mentorship, by the way. And again, I always say this, I just took week 1, 2, 3, 4, maybe a little bit 5, and that's what I ran with since October 2023. And that's what made me consistent, right? And I also took a concept from MXM Trader called internal external range liquidity. And I just blended the two together. So, all right. So when it comes to market structure, why is it so important to me? Is because it tells me when am I supposed to be bullish and when am I supposed to be bearish. So a lot of times, this is how we draw market structure. Okay. In a perfect world, this is what market structure looks like, right? And then we just have ranges from high to low, right? Every higher high to every higher low is a range. And that rule stays the same even if you have complex pullbacks. Now, if we start incorporating PD arrays with this, then it starts making sense, or footprints in this case. Let's say this is a fair value gap, right? So we're now blending very basic market structure with some areas of interest. So we have higher highs and higher lows. Okay, so we're identifying higher highs and higher lows. So whenever this happens, we're trending higher high and higher lows. All I'm looking for is whenever we have expansion, I want to see expansion into the previous high. That's external range liquidity. Whenever we get a pullback, I want to see us pull back into some sort of gap. That's your internal range liquidity, right? Either gap or swing point within this range. And so if we expand again, I'm looking for another high. If we pull back, what are we looking for again? Another fair value gap, right? So in a perfect world, this is what we want to see because this is just beautiful price action, right? And who doesn't want to see that would make all the money in the world? And so if I were to pull up an example for you guys, the most picture perfect example, that would be back in 2023. There's this a beautiful internal external range, right? Exactly what I just showed you guys, but flipped around. Bearish market structure right here. Price is creating lower lows, lower highs, lower lows, lower highs, lower lows. Look how clean this price action is, right? It just expansion, retracement, expansion, retracement, expansion, retracement. Every retracement, where does it go to? Fair value gap. Right here, above a buy side liquidity right here. Okay, so we expand. Where are we expanding to? Below some sort of sell side liquidity. So when we retrace here, we go into that fair value gap or buy side liquidity. We expand where? To the low again, making a break of structure. And so every time this happens, we can draw a new dealing range right here again. Where are we pulling back to? Some sort of fair value gap. In this case, it's created into this premium fair value gap to the T. Very well respected. Where do we trade next to? Equal lows. These lows creating a new lower low, right? And so we can see here that it just is on a complete, like a repeating cycle every single day, every single time frame. Price is doing this, right? And so that's basic market structure. This is a very simple pullback where it's just one leg goes up and it goes straight down, right? This is the price action we all know and love. This is when conditions are easy because we're like, okay, we just took a low. Now let's look for a fair value gap. All right, we trade into fair value gap. Let's look for a low. So on a higher time frame, this is even more clean because I remember doing this when I first joined STB. We were watching this in live time. It's pretty cool. So in 2023, what happened on the monthly chart here? The exact same thing, right? We had this low to this high being our dealing range, traded into this fair value gap from this high, right? Taking out this high, trading back into fair value gap. What are we looking for next? Another high, or in that case, we're looking for all-time highs. So it was very What a time to be alive. Now it's a little choppier, but we'll still get through it. Okay, any questions on the first part? All right, draw me the fib tool. Yes, the fib tool is the 50%. I just use the midpoint. So the midpoint is equilibrium, premium, discount. That's kind of what I'm paying attention to, and just range structure. All right, so let's move on to complex pullbacks. And this is what throws a lot of people off. And I can literally show you an example from yesterday, I guess. Yeah, yesterday. Actually, let me draw out the schematic first so it looks a little cleaner. So if you're creating higher highs, right, and let's say you identify that the market is just consistently trending higher, so your overall bias would be higher prices, right? So because this high is taken out, you're paying attention to the lowest low within the previous range. So this range right here, you're going to identify, okay, what was the lowest low within this leg right here? Was the lowest low. And so you're going to highlight that low, creates the break of structure, and then the new higher high, right? That's going to be your new dealing range. And so as long as you keep track of this higher high, higher low, right? You are to remain, in this case, because it's a bullish scenario, in this case, you are to remain bullish until that protected low is what we call it in market structure. But the lowest low within the previous range, until that low is closed below, you're not interested in looking for shorts, unless it's a retracement trade. But you're not interested in looking for full-blown shorts, pretty much. You're just going to be looking for continuation from areas of interest within this bullish range. You want to look for bullish areas of interest, and the only thing that you want to target is buy-side liquidity, right? When you're bullish, the only thing you're paying attention to is bullish areas of interest and bullish and buy-side liquidity. When you're bearish, you're only paying attention to bearish areas of interest and sell-side liquidity. Very important to note that as well. So in the case that, let's say you now have identified the new range, and that would be this low is the lowest low within the previous range, that creates a break of structure, and let's say this is the new established high. Okay, they're going to be drawing your new dealing range here, and this is what trips up a lot of people. Is within this range, sometimes you don't get a okay, there's a couple of scenarios that really trip up people. Sometimes you don't get a crazy pullback. You get a pullback maybe into 25%, and then it just shoots higher. That's completely fine because it still follows the same rule. You got a break of structure right here. What's the lowest low within the previous range that created this break of structure? We can identify it's the low that traced into 25% of this range, right? And so from there, we can already draw a new range because we have the same rules that apply, which is the lowest low within the previous range creates a break of structure. And so we continue to trail our range structure, right? So that's scenario number one. Sometimes a lot of people I see, they try to wait for price to go all the way back to discount or even OTE. And a lot of times price doesn't do that, right? So you have to be able to identify when price has already created that new break of structure, right? Scenario number two, complex pullback. So this one would be when price trades back into the range, and let's say there's a fair value gap over here, and then there's another fair value gap over here. So when price is pulling back, right, maybe you'll see it start not as clean, it starts chopping around and then creates price action like this. And when something like this happens, a lot of people think that this is the market structure shift and they're just going to straight up look for lower prices. But remember, you're still within this range right here. So until the range high or the range low is closed beyond, you are still remaining within this framework right here. So it'd be a different story if price closed above here, then you'd have a new range, right? Because this low right here is what created that break of structure. But as long as price is contained within this range, these little breaks of structure or these little market structure shifts, you can look at these as market structure shifts on a lower time frame, but you cannot use this as the current time frame, whatever we're using, as a market structure shift, because the only market structure shift is if price closes below this red line over here, which is the range low. That's the protected low, right? So if price trades all the way down here, closes below that, that's when we can start looking for the opposing range over here. Maybe there's a fair value gap over here, and then you can start looking for lower prices off of that, right? So sometimes price isn't as clean as over here, how we have clean retracements, clean expansion, clean retracement, clean expansion. Sometimes it consolidates. Sometimes it wants to chop around within a range and then expand. So sometimes you'll see price action like this. Let's say we trade into the first fair value gap and it looks like it's going to get respected. And let's say you took a loss on this. And this is what trips a lot of people up, is because they take a loss. So let's say you took a long here. Let's say somewhere around here, stop loss below this low, and then you wanted to target this high right here. Okay. For example, that's your trade idea. And so the market, let's say it trades right before this high and then drops into your stop loss and closes below this first fair value gap that you're paying attention to. A lot of the times, because of this loss, it causes a lot of developing traders to have some sort of emotional response and feel the need to, I guess, validate a new trade idea that's going against them. But that's not always the case. You need to understand what your framework is and if it's still underway. So whenever you get stopped out, that's why I always say this: when in doubt, zoom out. Because when you get stopped out, your framework, like your trade itself, may not have worked out, but your higher time frame idea or whatever your narrative is may still be playing out. Maybe price is just pulling back into this fair value gap down here so that it could expand higher. So this is something that throws off a lot of people. They'll look at this as, okay, I got stopped out here, inverted this fair value gap. Looks like we're getting market structure shifts to the downside by breaking these lows over here. So I'm going to continue looking for lower prices. And then this is where it's like up here, they had the right idea, but they just got stopped out. And then they try to flip their idea for a short and target the, let's say the other side of the range, right? Look for a short. And then little did they know, their plan initially was already correct, trades into this fair value gap and expands to this high, right? And then I think a lot of us have experiences where it's like, oh, I knew price was going to go there, but my emotions got the best of me, so I thought it was going to go the other way. Once I entered the other way, it just turned around on me and played out to my original plan, right? That's happened to me a lot of times, so I'm just going to go with it. So from here, you have to pay attention within this overall context. We are still within this range here. So until, again, I know it sounds like a broken recorder, but until this low is broken, being the protected low, the range low, you are continuing to look for higher prices. So maybe this trade idea number one didn't work out. Okay, over here, trade idea number one didn't work out. So what you're going to do is you're not going to FOMO into the reversal position, but rather if price continues to, let's say, reject off this first fair value gap, trades into the second fair value gap, and then gives you another entry confirmation from the second area of interest. This is where you engage your second trade idea, right? And so from the second trade idea, let's say you entered here and then you want to target this high, then your framework, your market structure, your range is still at play. So this is high probability that it will likely go to your target, right? And then what does this look like? Any guessers? What does this look like? I've put this arrow here as well. Market maker buy model, exactly. And so this is how we can dissect complex pullbacks, is through market maker buy models or market maker sell models. And for drawing your market structure, do you prefer the H1 candles or a higher time frame for overall range? So for me, I like to start from the daily chart. That's my bread and butter time frame alignment is daily chart, 90-minute chart, and then 15 or 5-minute chart. And so I always I always I always start from the daily chart, and then within that daily chart's context, I will use the 90-minute market structure. But your current range has like 3 pullbacks, so why not have a smaller range like you have 3 mini ranges? Great question, Farron, and you're jumping a little bit ahead, but great question. So when it comes to market structure, this right here, this framework overall, let's say this range is the daily chart. So how can we take advantage of a top-down analysis scenario is, let's say this is a daily chart where we have this range, right? And so on a 90-minute chart, we can then dissect this even further. So when price is back here, we're looking for what? We're looking for external to internal range liquidity idea, right? So let's say you're on the 90-minute chart and you wanted to trade this range right here, right? So this is going to be a lower time frame range. I'm just going to change the color. The green ranges are a lower time frame, okay? So let's say the blue ranges are a daily time frame. The green ranges are a 90-minute time frame or your 1 hour time frame, okay? So let's say on your 1 hour chart, now you have a market structure shift, creating a new dealing range to look for shorts. Why does this make sense in this context where you're not just only looking for longs? It's because you understand that the higher time frame is likely to create a retracement targeting internal range liquidity, right? So in this case, same thing applies within this range. Where's your internal range liquidity? Let's say there's a fair value gap here, right? Picture perfect, for example. What are you going to target? Internal range liquidity. So you could take a short, let's say somewhere over here, and look for that internal range liquidity. Nice little 2 hour trade, right? And this is exactly how I trade, guys. And so it's kind of layering it on top. It's market structure. My confirmation is SMT. That's it. So over here on the daily chart, do we have previous day high SMT? Let's say we have a previous day high SMT. Okay, do we have a lower time from SMT? Great. I'm going to look for lower prices from external to internal range liquidity. I'm looking for a higher time frame pullback as my intraday short idea, right? So over here, same thing. Another range is created. Let's say it retraces a little higher here, maybe back in the same fair value gap. Maybe there's a new fair value gap. Same idea. Over here, maybe you take a loss because it already traded into this internal range liquidity. So what I would be looking for here in terms of my model is SMT. But if you're just looking at like market structure or your model, maybe you would have taken a loss here. That is debatable, right? It just depends on what your confirmation is. So let's say we did take a loss here. The next range, so let's say we took a loss here just to like visualize it for you guys. Let's take a look at the next range. We get another break of structure on this low, and then so we're going to draw a new lower time frame range right here, and we're going to look for the same thing. We took out external range liquidity on the 90-minute chart. We know that this daily fair value gap is not really being respected anymore. And so let's say we have a fair value gap that is layered on top of this daily fair value gap we can look for a sell from. So from here, again, sell from internal range liquidity of the intermediate term time frame in alignment of the higher time frame because you're looking for this new internal range liquidity on the daily chart now, which is the second fair value gap pretty much. And I'll just annotate this so it's clear for you guys. Yeah, for example, right? So that's pretty much how I'm aligning these time frames together. Great. And so if we look at the today's example, for example, like I'm looking at the exact same thing. So on the daily chart, let's break it down. Daily chart, we have this high, right? This low, and we're trading higher. We have this range, took out external range liquidity. What am I looking for? Ideally, I'd like to see internal range liquidity. The thing that stands out to me most is this liquidity void, which is what I'd like to see traded into. And so we have a previous day high SMT. That's my confirmation, right? And so it makes sense for me to look for lower prices. If you don't use SMT, what can you use? You can use market structure. So over here, this is a 90-minute or intermediate term time frame market structure shift right here. This red line, right? This liquidity void being our target as of right now. And so you can draw your lower time frame range. And so what are we trading from? From a lower time frame range. Again, we can pay attention to our fair value gaps or whatever our areas, our bearish area of interest are. Maybe this order block right here. Maybe this fair value gap right here. Right? But as long as we're within this bearish range in the context of this larger range, I'm interested to look for lower prices, right? Looking for what? Daily internal range liquidity, which ideally I want to see this new week opening gap being tapped, right? So that's how I'm applying that to the live market as of right now. Does that make sense? Type one if that makes sense. And I promise you guys, if you incorporate this, this will simplify your trading so much. Because that's what it did for me. It simplified it in the fact that it tells me when do I pay attention to bullish PD arrays, when do I pay attention to bearish PD arrays, when do I look for buy side liquidity, when do I look for sell side liquidity, when do I look for market maker buy models, when do I look for market maker sell models, right? So all of that stuff. So as much as I would have loved to take this short idea today, now you guys see why I'm looking for this short idea. As much as I would have loved to take it today, there's just no model for me. Right. So it is what it is. It's fine. How are you identifying a range? Every range, if you zoom out, you see it's still in the previous range. So every range, what I'm looking for is I'm just looking for a break of structure. So let's say you have a leg of price right here. If I get a break of structure, I'm only paying attention to the current leg of price, pretty much. Sometimes I'll refer back, but that's like discretionary. So I'm going to show you guys objectively what I'm looking at. It's just every break of structure, I'm looking for a new range. So pullback, break of structure up here. That's my new range. Every time I get a break of structure again, that's my new range. Let's say you get a more complex pullback, okay? Get something like this. Doesn't matter. As long as it doesn't break this low, I don't care. I'm still going to look at this high, this low as the range, and still look for higher prices, right? Because this low never got taken out. And maybe this is the most ugly PA you've ever seen in your life, but this stands true. I'm going to show you guys an example of this that happened yesterday. Delete some of these annotations. Yesterday, I entered a short off of this change in state delivery, right? And my stop loss was at this high pretty much the entire day. And so why didn't I trail my stop loss, even though there's a break of structure, a quote unquote break of structure right here, quote unquote break of structure right here? Why did I trail to this high, or why didn't I trail to this high? Is because we haven't broken the range low yet. This is the range that I was paying attention to, right? Price trade back into premium. This was a fair value gap right here. This is a 15-minute fair value gap, which made it even better. But off of this change state delivery, that was what my entry was, right here. Stop loss above this high. Why is my stop loss above this high? Because I'm entering within this range, anticipating that this high right here is going to become the new pullback, right? It's just really ugly in this case because price consolidated within this previous range, which made price look really ugly. But that's what a complex pullback is, right? Where it's just chopping around within the range. If price, let's say I entered and it just swept lower, closed below this low, that's perfect. Then you would be able, very easy to see this new range, right? But just because it added a little bit of time to the element, a lot of people get tripped up and they think that this is a new thing when it's not. You haven't gotten the breakout structure with the protected or the range low yet, right? You haven't put in a lower low. So until price closed below that previous range over here, right? That's where I was like, okay, I still have nothing to do. I can't trail my stop loss. I'm not trailing my stop loss to this high. I'm not trailing my stop loss to this high. I'm not trailing my stop loss to this high because these are all minor highs. They're not a protected high. Protected high because this is the swing high, the highest high within the previous range, right? So this is the new dealing range that I'm paying attention to. We break below this low, external range liquidity, we trade back into internal range liquidity in this case, we have this fair value gap, internal range liquidity, and it trades lower. And what does it do? It closes below this new range low, creating a new range right here from this high to this low, right? And so because this new range was created after this candle closure below the previous low, what does that give us? Lower low, lower high, lower low, lower high, lower low, right? And so what I'm going to trail my stop loss to is the lower high. And so my short position yesterday, I closed it a little early, but this is pretty much what I was anticipating, is you would have trailed your stop loss to this high. For anyone that took the trade that I did it, at least, would trail to this high right here. And you just get stopped out on this 4 p.m. candle, right? So that's my trade yesterday, pretty much. So that is the logic behind my trading, my management, everything. That is the logic behind it. And SMT is the confirmation, the validation of my ideas. That makes sense. You only try to focus on the most recent dealing range. Yes, exactly. I only focus on the recent price action because that's all that matters to me. And if I need to pay attention to more price action, I just go up a time frame. That's my framework. This foundational information is so crucial to know, honestly. It's so, so important to know. Because once you understand this, it's like, this is what you need for the bias. Like, this is bias right here.